Well, David, we had the rand trading as firm as 7.35 just a short while ago, currently still below 7.40, and this is after hitting almost 7.50 last week, although it didn't close above that level, which I suppose is good news.
Well, that was the technical level, 7.53. It didn't manage to get above that. What that did, of course, is the weakening run over the last couple of days did flush a lot of the speculative positions out, the short dollar positions, long rand positions, as stop losses were triggered. Subsequent to that, obviously, we've had Greece drawing down on some emergency funding as far as the bailout package is concerned. That, strangely enough, ironically enough, put a little bit of a bullish tone into the market. The rand benefited dramatically from that, and of course we've had commodity prices continuing to rise and equity markets across the globe looking a little bit healthier. So despite all the problems in Greece and in Southern Europe, emerging markets doing quite well on the other factors.
Well, of course, we also had some economic data out of the United States on Friday. We had quite good manufacturing data, that was durable goods numbers. We also had new home sales data bouncing back, and of course more positive earnings reports. So it really does look like this is helping to boost the risk appetite that's suddenly re-emerging again, David.
Well, I think so, Stephen. You know, equity markets across the world are looking a lot healthier. Economic data across the world is coming out positive. Even in Europe, you know, despite the problems they're having as far as fiscal challenges are concerned, European economic data is looking good. The economic data in the UK is looking good. I guess Japan is, although slightly better, is the one sort of concern on the radar. But of course, the fiscal challenges are not going to go away. And that's going to keep interest rates low for longer to make sure that the economies are stimulated enough to generate the kind of economic growth that's going to generate the tax to pay off these deficits. And I guess that's why emerging markets are benefiting.
I mean, would you see this continuing for the remainder of this year, really, with interest rates remaining where they are and that carry trade continuing to boost our assets?
I think the big shift in sentiment will come, and I'm talking on a macro scale here, when interest rates in the US begin to move, if they show signs of inflation, and when the Fed begins to raise interest rates, and how other authorities or monetary authorities across the world respond to that. Until then, I think we'll have, on a macro basis, Stephen, we'll have some very good attraction for emerging markets, particularly high yielders or commodity currencies. They'll continue to do well with periods of uncertainty. But, you know, at some point, these fiscal challenges have to be met. And of course, closer to home, a lot of the unanswered questions that we still have floating around in our economic policy and economic policy shift.
Of course, we are getting some data out here in South Africa this week. We have the holiday tomorrow. When we come back to work on Wednesday, we're getting consumer price index numbers. We have the PPI on Thursday. Friday, we have the credit extension numbers and also the trade balance. What sort of a picture are you expecting to emerge from those data?
Stephen, I think certainly from a supply side, inflation is not under threat at all. You know, we've got very low money supply, no money supply growth at all. Credit extension is benign. So from that side of the fence, the inflationary pressure is really low. Of course, we've got Eskom on the other side and food prices to a certain extent on the demand side. But you know, the governor did announce last week that rates are on hold for now, and you know, those that were expecting another cut were perhaps a little bit disappointed. So took some steam out of the bond market and out of the equity market. But I guess the other side of that coin is that they are comfortable with what economic growth is doing at this moment in time to not have to justify another interest rate cut, because of course you know, we've only just crept in now on a CPI basis into the 3 to 6% range, and I guess the economy is doing enough to warrant a no-shift policy at this point.
Of course, our previous CPI reading was 5.7%. I think the market's looking for a figure of around 5.2% from the current reading. If we manage to beat that and go even lower than that, do you think that the possibility of an interest rate cut next month still exists?
Yeah, I guess there's always a possibility, Stephen, and of course the lower CPI goes, you know, the more that justification will come to the fore. But, you know, I also think we need to be careful of not creating pressure down the line, and I think Governor Marcus is very aware that, you know, you cut interest rates too far now, you create a problem for yourself further down the line. So I think they're happy with the steady as she goes policy, and in fact, from a currency perspective, over the medium term, that will act as an attraction for currency inflows and those that are happy to look into the carry trade as an investment solution.
Of course, Greece was also one of the talking points at the weekend meetings of the IMF in Washington, also the G20 meetings. What didn't really come up and what was maybe expected to come up was the global bank taxation and, of course, the Chinese yuan and whether that would be allowed to revalue. Are you surprised that the yuan didn't make it really onto the agenda at those meetings?
Well, I think the yuan is a Chinese decision. I don't think anybody, history tells us nobody's going to force them into revaluing. And I think, in fact, the prudent move is to allow it to strengthen gradually as it seems like they're allowing at this point in time. That would be prudent, allow the adjustments to take place over a period of time, perhaps allow some of the imbalances to smooth out. I think it would be really, really risky at this point in time to do one big revaluation jump in one single swoop. I think the prudent measure is to allow it to do gradually, and the Chinese have shown they're not going to be pressurized into doing things outside of their agenda.